This question tests the relationship between the gross profit margin, GPM, and the operating profit margin, OPM, and asks which business event could cause the gross profit margin to decrease by 5% while the operating profit margin increases by 3%. Gross profit reflects only sales and cost of goods sold, COGS, whereas operating profit also incorporates selling, general, and administrative, SG&A expenses. Therefore, it is possible for gross margin to decline while operating margin improves if the increase in sales volume or reductions in operating expenses more than offset the weaker gross margin. The key is to identify the scenario that can produce lower gross profit per sales dollar but higher operating profit through improved operating efficiency or economies of scale. A. An increase in the cost per unit of the goods purchased from a supplier. Incorrect. Higher unit costs increase COGS, reducing gross profit margin and typically reducing operating profit margin as well. B. A change to the variable costing income statement format. Incorrect. Changing the presentation format does not change the underlying economics or profitability ratios reported in external financial statements. C. A lowered selling price to increase quantities sold. Correct. A lower selling price reduces the gross profit margin because gross profit per sales dollar declines. However, if the price reduction generates significantly higher sales volume, fixed operating expenses are spread over more units and operating efficiency may improve, allowing the operating profit margin to increase. This explains how both changes can occur simultaneously. D. Sale of fully depreciated production machinery at a gain and replacement of the machines with newer models. Incorrect. A gain on sale is generally a non-operating or unusual item and does not explain a simultaneous decline in gross margin and increase in operating margin. Correct answer, C. A lowered selling price to increase quantities sold. Key takeaway, a price reduction can lower the gross profit margin, but if it stimulates enough additional sales volume and improves operating efficiency, the operating profit margin may still increase, making choice C the best explanation. This question examines the relationship between the gross profit margin, GPM, and the net profit margin, NPM, and asks which event could cause the gross profit margin to remain unchanged while the net profit margin increases. The gross profit margin depends only on sales and cost of goods sold, COGS. If it remains unchanged, the relationship between sales and COGS has not changed significantly. The net profit margin, however, is affected by all expenses below gross profit, including selling and administrative expenses, interest expense, and income taxes. Therefore, an increase in net profit margin without a change in gross profit margin must result from factors below the gross profit line. Students should recognize that changes in tax rates or financing costs can improve net profit margin while leaving gross profit margin unaffected. A. Sales decreased at a faster rate than operating expenses. Incorrect. This would generally reduce net profit margin because expenses would consume a larger proportion of sales. B. Corporate income tax rates decreased. Correct. Lower income tax rates increase net income after tax while leaving gross profit unchanged, causing the net profit margin to rise even though the gross profit margin remains constant. C. Preferred dividends increased. Incorrect. Preferred dividends affect earnings available to common shareholders and EPS, but they do not affect net income or net profit margin. D. Cost of goods sold decreased relative to sales. Incorrect. If COGS decreased relative to sales, the gross profit margin would increase, contradicting the question. Correct answer, B. Corporate income tax rates decreased. Key takeaway, gross profit margin depends only on sales and COGS, while net profit margin reflects all expenses, including taxes. A reduction in corporate income tax rates increases net income without affecting gross profit, making choice B the correct explanation. This question tests the concept of functional currency under foreign currency accounting standards, such as ASC 830 under US GAAP and IS 21 under IFRS. The functional currency is the currency of the primary economic environment in which an entity operates. It is generally the currency that mainly influences sales prices, operating costs, cash flows, and business activities. When determining a subsidiary's functional currency, accountants focus on factors such as the currency that primarily influences sales revenue, the currency that primarily influences labor, material, and other operating costs, the currency in which operating cash flows are generated and retained. The parent's reporting currency or the currency used to obtain financing is not necessarily the subsidiary's functional currency. In this question, the Swedish subsidiary's revenues and cost of goods sold are both affected by the euro, indicating that its primary economic environment is the eurozone. The fact that the parent company is US-based or that long-term debt is financed by Canadian investors does not determine the subsidiary's functional currency. A. US dollar. Incorrect. The parent company's reporting currency does not automatically become the subsidiary's functional currency. B. Canadian dollar. Incorrect. The currency of long-term debt financing is not the determining factor for functional currency. C. Euro. Correct. Since the euro primarily influences both revenue and cost of goods sold, it represents the primary economic environment in which the subsidiary operates and is therefore the functional currency. D. Swedish krona. Incorrect. Although the subsidiary is located in Sweden, location alone does not determine functional currency if another currency dominates its business transactions. Correct answer, C. Euro. Key takeaway: a subsidiary's functional currency is determined by the currency that primarily influences its operating activities, especially sales and costs. Because both revenue and cost of goods sold are driven by the euro, the Swedish subsidiary's functional currency is the euro, regardless of the parent company's location or financing sources. This question examines the concept of functional currency, an important topic in foreign currency accounting under IAS 21, IFRS, and ASC 830, US GAAP. The functional currency is the currency of the primary economic environment in which an entity operates. It is the currency that mainly influences the entity's cash inflows and outflows and best reflects the economic substance of its operations. When determining the functional currency, management considers multiple economic indicators, including the currency that primarily influences sales prices, the currency that primarily influences labor, material, and operating costs, the currency in which cash flows are generated and expended, the currency in which financing activities are conducted, the degree of independence of the foreign operation from the parent company. No single factor automatically determines the functional currency. Instead, management evaluates all relevant economic factors together to identify the currency that best represents the entity's operating environment. A. Selected on the basis of several economic factors including cash flow, sales price, and financing indicators. Correct. Accounting standards require management to consider multiple economic indicators when determining the functional currency, making this the most comprehensive and accurate statement. B. The currency of the foreign environment in which the company primarily generates and expends cash. Incorrect. Although this describes an important consideration, it focuses mainly on cash flows and ignores other relevant indicators such as sales prices and financing activities. C. Selected on the basis of cost-benefit analysis and ease of preparing consolidated financial statements. Incorrect. Functional currency is based on economic substance, not administrative convenience. D. The currency of the parent organization as the company operates as an extension of the parent's operations. Incorrect. The parent's currency is not automatically the functional currency unless it is supported by the underlying economic factors. Correct answer, A. Selected on the basis of several economic factors including cash flow, sales price, and financing indicators. Key takeaway: the functional currency is determined by evaluating multiple economic indicators, including cash flows, sales prices, operating costs, and financing activities, to identify the currency that best reflects the entity's primary economic environment.